Well, good morning, traders and investors. Today is Thursday. Believe it or not, it's Thursday. It's the 21st of January. The week is almost over. The market is still running on a sugar high post-election. Let's get into the news. Then I'll talk about the big report today. Then I'll talk about the sector or the ETF that's outperforming the S&P, the number one world sector right now. And then I'm going to give you guys 3 hot pullbacks. How about that? Pretty good deal, right? And I've got something important for you, so don't go anywhere. So, starting with the global economy, starting with the futures, markets are a little subdued. They're still up. We've been running hot the last 2 weeks. I mean, the markets have been just running. S&P, NASDAQ, all near new all-time highs. Now, in terms of the news and what's the catalyst for all of this, global shares mostly rose Thursday on optimism over new administration that set off a rally on Wall Street several days ago. Why? Because more support for the struggling U.S. economy, starting a recovery that's crucial for the export-driven Asian region and the rest of the world is what's most likely to come with President Joe Biden administration. At least that's what they're promising us. Japan's finance ministry showed the world's third largest economy may be crawling back to recovery. Fingers crossed and toes crossed. Exports for December rose for the first time in 2 years by 2% for the same month for previous year. This is positive. Imports declined 11%, plus marked the 20th straight months of decline. But this is very, very promising. 2% growth in exports. This is huge. Biden took a flurry of executive orders. He sure did. He's not wasting any time to undo a bunch of stuff that Trump did, for better or worse. During his first hour as president, he also pitched a plan to pump $1.9 trillion more into the struggling economy, hoping to act quickly as his Democratic Party now controls the White House and both houses of the Congress, which is huge. Analysts have been expressing concerns about pricey stocks, including myself, heading into the latest round of corporate earnings, which I will circle back to tomorrow. I figure it's Friday. It's going to be the last week. The end of the first week, major week of bank earnings. So I'll give you guys a full update tomorrow on that. But again, it's energy prices are going higher, and Biden is putting a fat carrot in front of everybody and wiggling it like this, and people are biting. So in terms of the news, we've got the big report coming out in just a few minutes, actually in about a minute. I try to time this so the report comes out while I'm talking to give you guys some perspective in real time. So the expectation for the report is 900,000, which is really bad, really bad. Last time, the report came in at 965,000. Now, folks, this is not a delayed report. This is for the week of the 16th. This is just recent. 961,000 Americans applied for unemployment. That's huge. And if the number stays right now, if it stays within this range or tops 1 million, we're going to be in big doo-doo, and it's going to give Biden a lot more ammunition to actually give more stimulus. So on one hand, it's really negative. On one hand, it's really positive. But again, last week, the only thing that was able to subdue this market was the report. I don't know if you remember last Thursday, the market started out hot and ended flat on its face. And a lot of it have to do with this report, because if people are not working, then how can they be spending money? And if they're not spending money, then how can retail sales and GDP grow? It's impossible. So again, consensus is 900,000. Now I want you to keep your eye on the futures, and we'll see if the futures moved. Notice the Dow is about 58, 59 points right now. It's in a fairly tight range. Let's see if the report came out. Let's take a look. Not yet. Probably another minute or so. Let's see here. Let me just try to get it again. Oh my goodness gracious. Right on the dot. Yeah, see, we're on the consensus level. But again, 900,000, 965,000. This is bad. Folks, this is the kind of numbers we were seeing in March, April, May, June of 2020. And I know Biden is trying to flood the economy with stimulus, and that's very helpful. But the underlying, you can only put a Band-Aid. You can only put so many Band-Aids on something. It's still a Band-Aid, It's still not going to cure. We need these vaccines to start hitting today. because again, folks, the economy is not in good shape. 900,000 new claims, 10 months after the COVID hit. That's bad. Bad. I'm not happy about that. And the market is kind of not really doing anything. The Dow's still in its range. I guess remember something. We were expecting this number. The consensus is 900. We're at 900,000. But again, still highly elevated 900,000. You see that? So again, we were expecting a bad number. We got a bad number. It's better than 965,000. At least it's 900,000. But I'm not happy about this at all. So, and in light of that, I want to show you guys something important. This is the S&P 500. Look at price and look at momentum levels before the sell-off. Look at price and look at momentum levels right now. It's exactly the same thing. You've got higher price, weaker momentum. Higher price, weaker momentum. That's called divergence, all right, between price and the oscillator. It's a classic divergence, and typically, usually, 99% of the time, except times when Biden's flooding the economy with money, it would have gone down. The market would have broke already. But he keeps putting money into the fire, into the pit to keep the fire going. The problem, though, folks, there's only so much money we can add to the economy, and there's only so much of a benefit it can gain. The bottom line is, if people are not working, you can put all the money into the economy you want. You're not going to get a benefit out of it. So I'm very cautious about the S&P and the NASDAQ 100 because they're both showing this pattern right now. And you guys all know that if the S&P and the NASDAQ drop, you know exactly what's going to happen with the Dow and the Russell. They're all going to cool off. But I got to say, the Russell is holding up better than expected, as I told you that it would. Now, I measure ETFs and indexes around the world. And right now, believe it or not, the U.S. indexes are not outperforming anymore. They're overbought. They're too parabolic, which means my scorecard for how I calculate these starts giving them negative points because they're just too high too fast. I mean, look at this. This is daily chart. Too much too fast. So my ETF model is now switching from US to Latin America. ILF now is in #1 spot. Notice it's been cooling off a little bit, so it doesn't get those points taken away. My ETF model actually takes points away when something is too strong. So again, the model is moving into Latin America. S&P is grossly overbought. Look at this. Upside, momentum. Look at this. The RSI can't even make its way up to 70 after this big move. That's telling us, folks, momentum is way overdone. Way overdone. I'm, again, just checking price. Yeah, I guess we're still in that subdued level. Folks, I'm going to tell you, these numbers, this number, if we don't get the vaccine to regular working people in America yesterday, this jobless claim report and retail sales numbers are going to drive us nuts. We also had the housing starts number. Let's see how the housing starts did. I'm just curious. I'm not as concerned with housing starts because housing starts, oh yeah, look at that. Housing starts is doing well, really well. Look at the consensus, 1.5 million. We got 1.6. So this is positive. There are some sectors that are doing well, but again, S&P 500 no longer leading. Latin America is now leading, and I'm going to give you three hot stocks that are pulling back. First one, Spotify. Makes an all-time high, pulls back, ready to go. 3 days down, fourth day up. That's called a 4x4 pattern. Makes an all-time high, and then swings down for 3 days, and then starts coming back. And it's still above the 50-day moving average. Next one, this is Capri Holding, but this is Michael Kors. They make leather goods. They make shoes. You guys have heard of Michael Kors brand. This retail company is doing really well. Again, all-time high, 3 down days, pulling back up, still trading above the 50-day moving average. Very bullish, and you can put a stop loss right below the swing low, just like you can put on Spotify right here. And next one is Peloton. We can't forget about Peloton. And remember, Spotify and Peloton, they're both stay-at-home stocks, while Michael Kors is not. But again, people have started buying retail stocks through e-commerce, and people are always going to need shoes. But again, Spotify, Peloton, and Capri, which is Michael Kors, CPRI. All these three stocks are having major pullbacks. And now, before I go, I've got something really important for you. Folks, stocks are cyclical, and that's a big key. For those who believe it's impossible to trade, with perfect results every time? It turns out you may be wrong after all. That's right. Famous trader and hedge fund manager and a really good friend of mine, Tom Busby, and I, we've discovered a secret trading calendar, and it's based on cyclical price action. And it could tip you off about stocks that have gone up on the exact same day, year after year, for 10 years straight. Imagine getting your grubby paws on that calendar. Same stock on the same day, every year, for 10 years straight, it goes up, and we're giving you these ticker symbols without any hidden fees or costs or anything. You've got to check out this calendar. You're looking at the potential to trade with 100% certainty on the decade. And again, it could tip you off to stocks that have gone up on the exact same day, year after year, for 10 days in a row. Click on the link below to see how you can access the secret trading calendar. Do it now. Don't delay. This is really important. And January and February of a new year are the best time to take advantage of seasonality. And that's what this is. It's really cool. And I've never ever seen it applied to stocks this way before. I've seen it applied to commodities, but this time it's applied to stocks. And folks, you've got to check out the results. Accuracy that I've never seen before. Follow the link below, learn all about it now, and post some feedback for me here. I want to hear all about you. And don't miss out on these 3 pullbacks. Bye, everyone.